Hey, hi everyone. So in this video, I would try to explain you credit default swap in very simplistic language. So credit default swap, if you go for any interview and they ask you what is CDS, CDS is nothing but credit default swap. So in a short form, usually people who use it very frequently, they call it CDS, which is credit default swap. Now, what is CDS? You can think of it as an insurance policy. So, all of us or most of us has insurance policy. What is insurance? You pay premium for something which you feel is a risk, like maybe some unfortunate event might happen. In that case, you pay some premium to insurance provider. So in that case, if that particular thing happens, that insurance provider will rescue you, will give you some amount for that premium that you are paying. If nothing happens, that is a very good scenario. In that case, what happens, you keep on paying premium, but at the end nothing happens, then you are paying premium, but ultimately you are saving yourself from a risk. The same principle applies to CDS. CDS is usually called this credit default swap. In this, what happens that people who invest in something or who have invested in some fixed income bond. So CDS, usually we call it out for fixed income products. I will explain that in some other video what are fixed income products, but for now you can think of a bond, or some T-bills or notes. So let's take an example that I have invested in a bond today. That bond is of a risk category. When I say risk category, that means it's not a government bond or something like that, or from very good corporate or anything. It is a lower rating bond. I've invested in today thinking that at this particular point of time I'll get this money and this interest. But maybe after a year I feel that this performance is not going good of this company and I might lose in this bond, things like that. Okay, so at that particular point of time when you realize that you have a risk, what you can do is you can choose someone who is ready to do this credit default swap with you. And in that case you can save your money which you have invested utilizing this particular instrument. I'll explain it to you. So let's take a very simple example. This is person A, okay, and this person has invested in this particular person B's bond and has given 1,000 rupees today. Okay, and it has some, this particular person B, it has some lower rating, and but for now its performance is not that much lower that you feel that you will lose all of your 1,000 rupees. But what if after 1 year this performance even decreases? So what will happen, maybe after a year you will feel that I will lose my entire 1,000 rupees. Then in that case what will happen, you will find someone, maybe person C. You could think of person C as an insurance provider. You'll go and you'll tell this person that I have invested, and there are many people who are sitting there in the market who try to be Mr. C, insurance provider. So it's not that you are reaching every individual and doing your stuff. There are people who are available in the market who are trying to invest in CDS. So what this person C will do, this person A will reach to this person C stating that I have invested this particular amount at that point of time to Mr. B. Now I feel a little risk, so I would like to indulge or involve in a credit default swap with you. In that case, what will happen? Like an insurance policy, Mr. A will pay some premium to C, and this premium, in this premium you are transferring some premium, like monthly premium or whatever is your term, you are also transferring your risk to C, stating that I will pay you maybe 100 rupees premium uh, every 6 months, okay? But if this particular person B defaults, in that case, Mr. C will have to give 1,000 rupees plus the contract interest rate, whatever is the interest rate, if any, that interest rate to Mr. A. So this is a credit default swap, that you indulge into a contract where you have invested your money into something. Later point of time also, if you feel that you lose that particular money, what you do, you get into a contract with someone where you buy and sell CDS, where you pay premium to transfer the risk if default happens. And if there is no default, if this B person pays you on time, there are no default check, nothing, in that case, like a premium, you just, like an insurance, you pay premium and nothing happens in the end, which is the best case scenario, right? Like no unfortunate thing happen, you got your money. So this is in the simplistic form what a CDS can be, credit default swap. Hope you like this video. If you liked it, please like my efforts, and please subscribe and comment. Thank you so much.